today's show, you'll hear investor perspectives on the growing software development sector. This is Investor Perspectives. I'm the host of Investor Connect, Halti Martin, where we connect startups and investors for funding. Software continues to eat the world, as Marc Andreessen once said. In today's show, you'll hear about a new company in the software development sector called KiwiTech. Our featured guests are Rakesh Gupta and Peter Bleyleben. I hope you enjoy this episode. Thank you guys for joining us today. We're 10 Capital, and we're hosting the Why I Invested webinar today focused on KiwiTech. We have with us the chairman and CEO, Rakesh Gupta, and the co-founder and CIO, Neil Gupta. And our investor today is Dr. Peter Bleyleben, who will talk as well here in a moment. We also have a chat box, so if you have questions, go ahead and fill it out. So with that, let me pass that over to Rakesh to give the investors a quick update on the KiwiTech opportunity here.
All right. Thank you, Hall. I'm going to share my screen here, share some slides. Hope everybody is able to see that. Okay. So KiwiTech is it's a unique model for making what we call cashless investing. And I'll start off with some background on what we do in terms of the model that we have is that we do technology development for startups, and we take half of our fee in equity. So say there's a $500K technology development SOW. We would do that, maybe it'd be over 2 or 3 years. But what we would do is the startup would give us $250K in the form of equity, in-kind equity, and then would charge them $250,000 in cash over the period of the development, over 2 or 3 years. So we get this equity up front. We're aligned with the startup in terms of creating value, helping them, get new investors on board and helping them with any advice. And this provides an interesting partnership. It also allows us to make a series of early stage and late stage investments without having to write checks. So it's set up as an operating company, about 450 people total. A lot of them are based in New Delhi, where the programming is done. And then we have a business development team and management over in the US. And we have a whole ecosystem of events. And this has actually benefited from the lockdown. We had these demo day events that we were doing before the lockdown. We were doing about 6 to 8 of these per quarter. And these demo day events are where our portfolio companies, say 6 to 8 of our startups, will present. And there were usually about 15 to 25 investors in the room. We did these in Texas and Austin, Dallas, Houston. We also did them around the country, Chicago, New York, Boston, DC, San Francisco, LA. So East Coast, Midwest, West Coast. And then we also had a workshop series in late 2019. And then in February, we started experimenting with online demo days. We were thinking it might be interesting to see if we could take some of our events and move them online so everybody didn't have to fly all over the place for an event. And we started using Zoom. And we thought, maybe over a period of 12 to 18 months, we'd move maybe half of our events online. Of course, then lo and behold, in mid-March, we had the lockdown. And within 2 weeks, we moved 100% of our events online. And it actually led to some experimentation in terms of having a broader set of events. And, we went from doing 6 to 8 events to we're doing 20 to 30 events now per quarter. It includes demo days, VC panels, family office panels, venture fair. So a variety of events, all done through Zoom, no travel cost. It's easy for, investors and startups to participate. And rather than getting the 15 to 25 investors we did at a typical demo day, now we get 40 to 50 investors in a Zoom environment. And our larger events, our VC panel and family office panel, we get 300 to 500 attendees. So here's an example of some of the events that we do. We have a venture capital panel where we've had top VCs participate. We launched this in May, and we're doing it, fairly frequently every month, a month and a half. And we have, funds like NEA, it's a $24 billion fund, or Edison Ventures, which is a New Jersey-based fund that have presented. And then we also have a family office panel that we launched in August, where we had the Forbes family office, the Koch family office, and the DuPont family office as panelists. And we had 4 of our strong kind of later stage startups presenting. And at these events where we have 300 to 500 people, we can actually match up the startups and investors. And the way that we do that is that, we send a list of about 100 VCs after the event that have attended our events in the past. We send it to startups. They can select up to 25 startups. And then we send a list to the VCs and they can opt in for those introductions. And out of each event, we make about 50 to 100 introductions. So just to give you an idea of some of the event ecosystem that has developed over the last 6 months, we have a female founder demo day. We have a lot of female founders in the mix. We've been doing this for a while. It used to be primarily in San Francisco, but now we're online so people can participate from anywhere. We also launched a Black Entrepreneurs Matter demo day in July. And we have an online workshop where startups get education on different topics. We have a large techathon event, which is going on right now this week, and also industry panels. So these are a variety of ways in which we help the startups that we work with. And we also have a unique deal funnel for finding the startups. In 2019, we reached out to 40,000 startups across the US. That led to about 60% of them responding positively, 6,000 phone calls, 2,000 meetings. This is all on Zoom now, and led to 109 new portfolio companies last year. So as of the end of last year, we had 250 portfolio companies, 165 of those over the last 2 years, 18 and 19. And that has led to kind of some significant growth in our model. These are some of the startups that we've invested in, but I'll show you some of the numbers and we'll come back to that. And in terms of numbers, we have scaled 37% from 2019 to 2020. We're going to do this year $25 million in net income. The net income is primarily in the form of in-kind equity today. And what we're doing is now we're growing our cash EBITDA as well. So over the next few years, we expect to get to $100 million in EBITDA, of which $25 million would be cash EBITDA and 75 will be in-kind EBITDA. And then I'll cover a couple of the things that I skipped over. Founder background. My brother, sister, and I had founded a company earlier called Aptara. It was a content services company that we scaled to 5,000 people and sold in 2012. That's what we did prior to this. And in our current company in KiwiTech, we have two large investors, family office investors, Tom Wells and Dan Rizzo, who are both on our board. They collectively invested $6 million in the business. And then in terms of what we're doing today, we have a convertible note. The company's raised about $25 million in capital so far, mainly from individuals and family offices. We're doing a convertible note of $10 million with an 8% current pay, paid out quarterly, and a 1x liquidation preference. And it converts at $8 per share. It's got a 5-year term with 2 1-year extensions. So that's quickly about KiwiTech. And I want to just share a little bit about some of the companies that we have in the mix. We have about a dozen companies that we think are looking as potential exits over the next couple years. We did get a couple offers this year to get bought out of our positions in Series B rounds, but we declined because those are some of our stars and we don't want to let go of them. But Urban FT, this is a company that we started with pre-revenue, pre-product, at a $10 million valuation. They now are up to $100 million valuation. They're raising a $60 million round, $20 million run rate this year. And upon exit, we think our value could be about $9 to $11 million over the next couple of years. Then Hungry, this is a catering platform, a technology platform for catering. We got $150K equity at an $8 million valuation in 2017. They raised $20 million at a $100 million valuation earlier this year, and our equity is worth about $1 million now. We think they're on path to becoming a unicorn. The CEO did a great job of pivoting during the lockdown, added 3 new services, and so we think this has good potential. And we have a software platform, kind of an Uber for buses, that we invested $1 million in last year. They're now raising money at a $60 million valuation. So we think this has potential to scale and deliver some meaningful value to KiwiTech. So just to give you some examples of, some of the types of companies that we have in our portfolio. So that kind of wraps up the KiwiTech presentation.
Thank you for the recap of the KiwiTech deal. Now I'd like to turn to Peter Bleyleben. And Peter, can you tell us a little bit about your background as an investor?
Sure. Yeah, I want to go a little bit further, just very quickly. I'm on my third life. My first life was senior partner at Boston Consulting Group. And then I co-founded a specialized finance company that I brought public at the New York Stock Exchange and absolutely hated being CEO of a public company. And we had a little hiccup in 2002, I think, yes. And so I stepped aside as CEO, remained chairman on the board. And since then, I've basically been a reasonably active angel investor in the metropolitan Boston, Northeast corner of the United States. And I serve as investor, as a mentor, as an advisor, as a board member. So that is very quickly my background. In terms of specifically with Kiwi, Rakesh, correct me, but I think it was around 2015 or so that I met you guys. And I was intrigued at the early phases by two things, actually. And I never realized how much more potential there actually was in this thing than what I originally thought. I was intrigued by, I always wanted to be kind of a general partner in those investment funds, and not necessarily a limited partner, because I really think if you're successful, the real money is on the GP side. And this was the first opportunity for me to basically participate in the success of the GP. And I love this, I would call it risk-reducing model, that they got paid in cash for their costs, that they provided the services for the companies, and the other half or whatever percent was in equity, like a real investment fund. No cash involved from the investors. There's no LP. So I, as an investor, will make money if the GP makes money, which I'm sure, hopefully, we will make. The second issue, the second area, which was very intriguing for me, as an angel investor, you tend to focus on companies in your geographic area, which for me meant Boston, which is not necessarily a bad place to be an angel investor, but everybody else is here. And the valuations tend to get really crazy in those centers, like being in those days, Silicon Valley and Boston, basically. And Kiwi from day one was intriguing to me because many of their companies came outside those prime spots. And whenever you go outside of the prime spots, you tend to get better valuations as an investor than if you sit around in Silicon Valley and in Boston and so on. So those were the things that intrigued me the most, which made me invest basically as one of the quite early outside investors in Kiwi.
Great. So what do you normally invest in? Aside from KiwiTech, what type of companies do you look for?
Well, I'm in Boston, right? So it tends to be software, right? I did some life science investments, and quite honestly, I think, did I make money on one of them? Yeah, I made actually, that was kind of a weird deal. That I made a lot of money on one of them, which wasn't really necessarily life science, more software. But generally speaking, I lost money in life sciences, so I don't touch them anymore. Exits take forever, and you can go to whatever, phase 2 or phase 3 even. And then suddenly the whole thing that was valued $1 billion a day ago suddenly is worth essentially nothing. So I have shied away from life sciences, but I do like software. And I don't see much of it in Boston, but I do like things where I can actually touch it. I can see it. It's kind of a product that is tangible. So that's basically my investment philosophy. I'm a big fan on the entrepreneur itself. A good entrepreneur can make a bad idea successful, and a bad entrepreneur can make a great idea totally fail on you. So getting to know the entrepreneur is one of the key aspects of how I invest. And I mean, I met the Guptas, and I kind of was extremely comfortable on day one on them.
What did you like specifically about the team? What made you comfortable with them?
Clearly experience. I mean, they have seen it. It's always difficult to invest in a kid coming out of college and deciding I have the greatest idea and let's just go and do it. Rakesh and his siblings clearly have the experience, and they have seen it, right? I mean, they built a company of 5,000 people. They clearly have software skills. They clearly know how to do it. And I was extremely comforted by that background.
And so why did you think this company would be successful? And today, looking back, is it still the same reasons or is it different reasons why they're successful?
I think what I did not recognize in the early days, as much as I recognize now, is the amount of value that Kiwi provides to their portfolio companies. Rakesh brought up a few of those seminars, workshops, getting together with investors regularly. So I describe them as all VCs say they are value added and they provide value to their portfolio companies. Everybody says that. Normally, I don't see it besides them sitting on the board and maybe making one or two introductions in their lives. With Kiwi, I see it every day. They take the idea of value-added investor really seriously to heart. And I think I like that a lot because it improves their reputation out there. Right, so investors in the companies know that those companies had a lot of support, and the entrepreneurs know that if they go to Kiwi, they get good stuff out of them. And it's very, very difficult for VCs to get a good pipeline of prospects. And if your reputation is good, as really being helpful to the entrepreneurs, I think that's very helpful to get a high quality deal flow.
What challenge did you see the company overcome, or what was the biggest challenge you saw them overcome over the time you were with them?
Well, I don't know. I quite honestly have not seen many problems. I mean, maybe they didn't tell me about them, but definitely here they are growing. So they must be doing something right. I think on a pure operational point of view, the speed at which they converted their basically personal touch to the remote world since March was for me astonishing. I mean, I've seen a lot of companies that took way, way longer to get used to the Zoom world than what Gupta and his company did. So that was definitely good.
Great. So you mentioned several reasons why you invested, but what excites you most about this opportunity? What's the one thing that gets you the most excited about KiwiTech?
I think the ability to expand the product offering, to provide first top-notch services to the entrepreneurs, and the basic business model. I mean, some people, and more than some people, have tried to get paid in equity for the services that they provide. It tended to sound better in theory than in practice because it never is really clear the VC or the service provider or whatever. KiwiTech, I think, has figured out how to do it well. Over the years, I think, Rakesh, correct me if I'm wrong, but I think you increase the cash proportion of the software services that you provide over the years.
Yes.
So that allowed basically the company to become cash neutral or even slightly cash positive while still growing without coming back to the Bleylebens of the world for a lot of additional financing. Now we really want to do some growth financing, and that's now a different story. But this financing, I think, will be a real Kickstarter for very successful additional expansion.
And how are you helping the team at this point?
I'm a friend. I mean, being here, for instance, I participate in many on their panels and be helpful in wherever I can, but I don't have any specific role in Kiwi.
Great. My final question is, what else do you think the other investors should know about the company that we haven't mentioned so far?
Rakesh, you're going to hate me, but they are approachable. When I need something, when I want something, I send an email, and I actually do get an answer back within a reasonable period of time. I'm an investor in many other institutions or other places where I get an email, and if I'm lucky, I get an answer back in a week or so. So it's very comfortable feeling for an investor that you have a management team that is responsive to reasonable questions. They don't hide anything. They are open. So after now 5 years, I would definitely do my investment again as I did 5 years ago. And there was another follow-up round a couple of years later that I also did.
Great. Well, I appreciate your comments. I want to thank you for those. For other investors that are on the call today, if you have any questions, go ahead and put them in the chat box. At this point, I'd like to go back to Rakesh and have him give a quick update on the current status of KiwiTech and the offering.
Yeah, thank you, Peter. Appreciate it. So in terms of an update, this is a $10 million facility. We've raised $2.5 million against it, and we're continuing with that. And we also plan to add some additional services into the mix. Peter had referred to that in his comments. Besides technology development, we want to be able to offer accounting services and marketing services to startups. So we think that's an interesting expansion because you take the same startups and we're already offering technology development to them. Accounting arguably has a much broader application, and which investor doesn't want to get like good accounting statements out of their startup? That's always a challenge, right? So that's one thing we plan to add, and we also plan to add services offering into startups. So these are some of the things that we plan to do going forward.
Can you talk about the specific terms of the investment, valuation, et cetera?
Yes. So the valuation, so the convertible note is set up with a 8% coupon. And again, that gets paid out on a quarterly basis. So it's a convertible note that actually pays. It's set out for, someone's asked to show the slide. So I'll just put that up here. Let's see here. And it is a 5-year term with 2 1-year extensions. So I'll just put that slide up for you to see.
Great.
And it has a 1x liquidation preference, naturally being a convertible note. It sits ahead of the common equity and preferred equity. And the conversion is the $8 per share is based on about 4 times this year's net income, plus the value of the in-kind portfolio as of the end of 2019. So that's about $150 million because we have $25 million in net income this year. I'll go back to that slide. And on the balance sheet, we have about $47 million in assets at book value as of the end of 2019. So coming back to this, it's a 5-year term with 2 1-year extensions. We're planning over the next 2 or 3 years to be able to do an M&A or IPO type exit. We would expect that exit based on the numbers and how we're tracking to be at $40 to $55 per share, which is basically the value of the portfolio at book value plus 8 to 12 times net income. And over time, net income from cash net income will be increasing.
Right. We have the next question there. How do you evaluate the businesses to whom you provide services for cash and equity?
So usually the way that we value a business, a startup, is, it's in line with the way angels are investing in it. So in other words, if it's a $5 million valuation for the angel round and people are writing checks at $5 million, that's a valuation that we'll go with. So we tend to just benchmark off of the valuation that an angel investor or a fund is investing in.
So you provide services to everyone, and if so, how do you choose which businesses to provide services for and which not to provide services for?
Well, we're open to providing services for any startup, but whether we do the in-kind model or not depends upon whether we agree with the valuation, we agree with the potential of the team. As Peter says, he looks at the management team. We look at the management team first, and we tend to have a lot of experienced entrepreneurs in the mix. And then, of course, if things look good from an investment perspective, then we'll do an in-kind deal. If not, we'll do an all-cash deal. We'll say, well, let's just start out as an all-cash model, and then we'll see later on whether or not we do in-kind.
Do you have a rigorous due diligence process? Can you describe it a little bit?
Yeah, we have a diligence process where we look at some of these things that a VC would look at. Well, I wouldn't say that we don't necessarily look at it investing in venture quality companies. We're investing more like an angel investor or seed stage investor. We do have later stage companies that would be more like venture quality, but we have a diligence checklist, which I'm happy to share with anyone as a follow-up to this.
So how many companies do you evaluate to get one company in your portfolio? What's the initial screen versus what finally ends up as one company? If you have a ratio there, that'd be helpful.
Yeah. So out of 24,000 companies that respond positively, you could look at it as, 6,000 phone calls go to 109 companies. So it's kind of about 1 to 60 from the initial phone calls. There were about 600 companies that were reviewed. So in other words, they made it through these two stages. So about 1 out of 6 of those we invested in.
Very good. And is KiwiTech open for new startups only, or does it conduct, current and existing business with new business lines?
New startups, meaning like startups that are just starting, pre-product, pre-revenue?
Right. You only work with new startups, or do you work with existing businesses that just want to start a new product line and just need new services?
Oh, usually it's new startups, because if it's an existing business line, if it's an existing business that's starting a new product, then we'll just do that on an all-cash basis. We wouldn't do that in any kind model.
Okay. Is the deal to the startups always 50% cash, 50% warrants, or are there other combinations?
Yes, it is all, because initially we started out with 20% in kind, 50% in kind, 100% in kind. And we found it was complicated because the startup would feel like, well, you don't believe in them if you do 20%. And it wasn't as compelling an offer. If you did 100%, we're taking too much risk. So we just decided to do 50% and work with companies that meet the threshold.
What are the biggest challenges the company is facing right now? And can you talk about how COVID has impacted the valuation of your companies?
Well, I think in terms of, we're seeing both positive and negative impacts of COVID on our portfolio. There are clearly companies in the travel and hospitality space that had to take a pause. And what we're seeing kind of post-lockdown, some of those companies are coming back. That Airbnb for Billionaires company we have called LVH, they're actually having a record quarter this quarter, but they had basically no revenue in April and May. And then we see healthcare companies and fintech companies, they seem to be doing quite well. So I think it depends upon which space the company is, whether they've been doing a successful job of pivoting and adapting to the new environment. So a lot of it depends on that. We have an events company called Event Combo. They were focused on in-person events. They pivoted to online events, and I think they're going to be back to this pre-lockdown run rate in the next month or two. And they have the potential to grow a lot more than they could with in-person events.
So what's the biggest challenge you face today?
I mean, the challenge is just managing the growth, the scaling, making sure we do good events. It's all about execution.
What percentage of the portfolio companies have gone under due to COVID?
Right now, we haven't seen, I'm expecting that there would be fallout. And we did make a provision for kind of more write-offs starting in 2020. Partially because the portfolio has grown, but also because we're thinking that there will be write-offs. But we don't have that many companies that have actually thrown in the towel yet, but I'm sure there'll be cases of that. People that are connected with the hospitality space or travel space.
So the next question is, what is the minimum investment level for KiwiTech?
For the convertible note, $250K is kind of what we prefer. We can be flexible about that, but we kind of prefer $250K or more.
So for the new services, what competitive advantage do you have that would make the existing customers get additional sticky services like accounting and marketing? What makes that sticky for you guys?
Well, I think one is in our portfolio, we have over 250 companies, so we can go out to them for these additional services. And we already have a pre-existing relationship with them and a contractual relationship with them as well. So it's easy for us to add those services on. And then also because of our event ecosystem, workshops and other events, it gives us a very good forum in which to promote these additional services. So it's more just kind of being in that space, being connected to the startups, existing portfolio companies, and new startups that we're connecting with.
Cool. And so next question is, aren't most founders very stingy about giving away equity, especially in an environment where there's a lot of money chasing deals? Why would a startup choose to give away equity versus pay for development in cash?
Well, I think in general, especially at the seed stage, raising money is a challenge, because startups are having to raise money at, 25, 50K, 100K at a time. So if we can say, all right, you're going to raise $500,000 and you need to develop your product, instead you only have to raise $250, it reduces the amount of time they have to put in fundraising. And it gives them a vested partner because now we're very strategically aligned with them. We're aligned with their success and want to help them make introductions or do whatever we can to help them. So it brings a value add partner, alongside them.
Right. And can you give a breakdown of the companies in your portfolio by sectors, fintech, healthcare, et cetera?
We have a fair amount of healthcare and fintech. Those are probably our two largest categories. I don't have the numbers offhand, but yeah, those are big areas for us, healthcare and fintech.
Great. If there are any other questions, go ahead and put them in now. I know we answered many things, but there may be new questions coming up. And just wanted to see if there's any last minute questions here at this point. Rakesh, what are your final closing words there you'd like to give to the investors that are online today?
Well, thank you for attending and participating. I think we're building a pretty unique model at scale. There are clearly companies that have taken equity in exchange for services, marketing services, or technology development services. But I think we have a pretty unique model in terms of how we've scaled that and how we've created a virtual startup ecosystem. And would love to chat with you if you're interested in taking a look at this.
Great. I want to thank you for taking time today to share this information. I want to thank you, Peter Bleyleben, as well.
There are a couple of questions. Can we answer them, please?
Oh, we do have a few more questions. Let's go ahead. A few more have come in. Before we jump off, let's go back up. What is the lead time for a company from first phone call in the funnel to participation? How long does it take for them to go through your process?
The lead time from call to in-kind deal, it's probably about 6 to 8 weeks is the time frame.
Okay, 6 to 8 weeks. That sounds good. And who is your biggest competition and how do you compare with them?
Well, our competition are other technology development shops that will just do this for all cash as opposed to having an in-kind component. That's our primary competition. And I guess the other area would be for technology development would be their in-house capabilities because we're more like a shared service.
And how do you say you're better than doing it yourself? What would you say is the big advantage you have over those who are just rolling their own?
Well, one is cost because we're doing it. Their out-of-pocket cost is much lower per development hour. But the second is that as they're building a product, there are ups and, there are kind of increases and decreases in the amount of time being spent, right? So with our model, they can basically staff up for development of a new version, and then they can staff down as they're going to market and trying to promote that version, just doing enhancements. So their staffing can be variable depending on what's needed. So they don't have to have a lot of fixed costs to support that development.
The next question is, how much funding have you helped portfolio companies raise? Do you have a total figure there?
The companies that have revenue, I can tell you kind of it's a fair amount of capital, but in terms of percentage of startups that present at our demo days, about 40% of the startups that have revenue raise money. And the pre-revenue startups definitely it's more of a challenge for them. I would say it's more like 8% of them raise money. So having revenue versus not having revenue has a significant impact on how many of them raise money through our demo days.
For those who have revenue, is there a standard amount, like a 50K, 100K, 300K?
Yeah, so it varies. Yeah, it varies anywhere from like 100K to $1.5 million per company. The companies that have done well have raised about 1.5 out of the demo day series. But usually if they raise money, they raise at least 100K.
And how stable is your developer workforce? Has there been any turnover in the team, and is retaining the talent a challenge?
It's generally been pretty stable. It's India-based development, and the India-based companies tend to have a higher turnover, but we manage that with good kind of company events and morale, a lot of employee events, and that's worked fairly well. So we do better than the industry average in terms of turnover.
Okay. Well, the next one is the biggest challenge with technical development is that the requirements change all the time. How do you manage the change of scope from the tech when it's always moving? That's
a very good question, actually. It's very true, especially with startups. They talk to an investor and the investor says, you need this feature and they want to add this feature. So what we do is we have an agile development process so that they can make changes on a, kind of adjust course on a weekly basis. And we prefer with startups to have a team-based approach where they have a development team. So if they're changing course and there's some additional work to be done, that gets figured into just additional development hours.
Great. And so for investors, do they get access to an online dashboard to track the performance in real time?
We do quarterly reports, and the quarterly reports have a kind of a report of how things are tracking in our investments.
got some people really appreciating the answers and the presentation you guys made today. Thank you for joining us today. As always, be sure to leave a review, subscribe to this podcast, and share it with others. Let's go start up something today. Team Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.